perhaps we can get started again. We're going to change the program ever so slightly. Rita Maio of the ministry has come up to me during the break and asked if she could speak about two matters. One that she omitted to mention in her remarks regarding business name registrations. And the second was as a result of some inquiries made during the break about electronic registration. So I'll just turn it over to Rita.
Thanks. I did forget about business names. It was on page 2, and I didn't include it on your handout. And quite a few people came during the break and asked me, as far as business name registrations under the Business Names Act, not to be confused with limited partnerships under the Limited Partnerships Act, just the straight business names, partnerships, sole proprietorships, or what we commonly call style names, there is no property in those names under Ontario law. So 3,562 people can register as Acme Cleaners, and I'm sure you know there are that many. You come in, you file the form, and it's registered. As of October 23rd, 1995, Ontario Regulation 441/95 came into force, which amended Ontario Reg 121/91, which no longer requires signatures, which is a very important change because it allows us for electronic registrations. We no longer require a person signing the Form 1 and the Form 2 under the Business Names Act. And again, this is not the Limited Partnership Act. Those same provisions have not been made. But there is no longer a signature required. In the place of a signature, we require merely the name of a person authorizing the registration. And a person can be a real person, or it can be a it can be a partnership, or it can be an agency, or it can be a corporation. So that's the major change that we've made to the Business Names Act. And a couple people have asked about the OBRA stations, the Ontario Business Registration Access Stations that there are. There's about 35 now, with another, I think the government announced in the latest budget, I'm not sure you read all the little details, but I think they're going up to 100 stations across the province, which means that you can go in, register, do your registration on a PC, and then it's uploaded every night to Toronto. OnBiz goes through the process, prints it out, and then in about 2.5 to 3 weeks you get your registration back. And as one of the people mentioned, it's a lot better than the 6 to 8 week mailing time turnaround that we have. If you can't come down to Toronto to register in person, then it's only about an hour. And hopefully September the 1st, release 4 is coming in. Well, you'll be able to do it on the spot, which means not just the data entry, but it'll interface with OnBiz in Toronto from wherever you are, and it'll actually print out the form back for you, a confirmation of the registration. So you won't have to wait the 2 or 3 weeks. And the other question that I got was about electronic filings and electronic incorporations. There is a request for proposal out on the street right now. We're looking for value-added service providers. As opposed to us doing the searches for you in the company's branches in Toronto, there will be this 1 or 2 or 3 or 4, whatever service providers that will be doing the searching for you. And because the government is cutting back, personally from my office, I've had to surplus 15 employees, which means that they won't be able to do the searches. So the government is outsourcing as they are doing a lot of other things. That RFP is out on the street right now. We're hoping that sometime in the early fall, we're going to have that. And one of the first phases is only the searching aspect of it. So the corporate profile reports that you're now getting in the branch or through the mail, you will get through these other service providers. The second phase of that will be electronic filings, the Form 1s and 2s, special notices, annual returns that we were talking about before. So I just wanted to point that out to you, and thank you for the time, and Elizabeth.
Our next speaker is Elizabeth Johnson, who's going to speak on rollovers, I believe, particularly with respect to Section 85, but if you look at her paper, there are other rollovers that she'll be addressing as well. Elizabeth?
Thank you. I hope everyone got a copy of the paper. Unfortunately, I had to bring it up with me as I was just polishing it off last night. I'm going to skip around a little bit, but I just want to point out that at the back of the paper there are a couple of appendices, which I haven't particularly well numbered, but there's an asset purchase agreement, and I'm going to make some comments on that. There's also a share purchase agreement, and I have included some preferred share provisions with a price adjustment clause in them. As usual, I caveat that while I think they're pretty good precedents, every situation is different and people's drafting styles are different, and they should really only be used as a reference point. And obviously, there's constant updating required of any kind of material like this. Let me just say a word about the term rollover. I was asked to speak about rollovers, and I guess most of us think about Section 85 when we think about rollovers, and I will concentrate on that. But you should know that the term is simply a generic term for any transaction in which the cost for tax purposes of one asset rolls over into the cost of another asset. And this may be a share being exchanged for another share where the cost of the old share becomes the cost of the new share. In an asset rollover, we're talking about transfer of assets, typically at tax cost, but as we'll see, Section 85 is a very flexible provision that allows for recognition of gain, and in some cases, the reason for doing the transaction is in fact to recognize gain, as I'll mention in a minute. The other sort of rollovers that I've dealt with in the paper in a somewhat more detailed way are 85.1 share-for-share exchanges, Section 86 share reorganizations, Section 51 share and debt conversions, and then at the end I've mentioned the fact that the term rollover also is used to describe what happens on a Section 87 amalgamation, an 88.1 wind-up, and a variety of other reorganization provisions in the Act, including some partnership reorganizations. Having said that, I will turn to the Section 85 rollover, which is the most useful as well as the most flexible of the rollover provisions. This section permits a taxpayer who holds assets having a value higher than their cost for tax purposes to transfer those assets to a corporation for consideration that includes shares, but is not limited to shares, and to elect a transfer price for tax purposes that either defers completely or reduces the current gain that would otherwise arise on the transfer. And just to point out, that might not be a capital gain, it might be an income gain such as a recapture of capital cost allowance on depreciable assets. Why would a Section 85 election be made? The most common reasons I've listed in the paper. One is to transfer an unincorporated business to a corporation on a tax-free or tax-deferred basis. This might be for tax reasons, for example, to allow the shareholder the benefit of the small business deduction, but it might be for non-tax reasons such as limitation of liability. Section 85 rollovers are commonly used to transfer assets among corporations. For example, a corporation one corporation may have a profitable business and there may be a related corporation that has tax losses, and it may be desirable to transfer the profitable business into the lost corporation. Common use of Section 85 rollovers is in an estate freeze situation. I'm not going to deal with details of estate freezing, but that's an obvious example where Section 85 elections are made. Alternatively, an estate freeze might be done using a Section 86 reorganization. As I mentioned, sometimes the purpose of the Section 85 transaction is to actually trigger a gain as opposed to deferring a gain. One of the situations where this occurs is where the holder of shares that qualify for the $500,000 capital gains exemption for small business corporation shares wants to do what's called crystallizing the gain. That might be done by rolling over the shares into a new company or actually transferring the shares back to the same corporation and making a Section 85 election at an amount which will trigger a capital gain equal to the available exemption. Another situation where Section 85 rollovers or transfers are used is in the context of an arm's length sale. For example, in a takeover situation where one corporation is being taken over by another corporation. Often that type of transaction qualifies under Section 85.1, which I've dealt with in the paper, but in some cases it may be advantageous to make a Section 85 election instead. I'm not going to review in any kind of detail the technical requirements or the provisions that govern what amount can be elected on the transfer. I've dealt with them in the paper, and certainly they're exhaustively dealt with elsewhere, but I do want to mention a couple of points. The basic definition of a Section 85 transaction is a transfer of eligible property to a taxable Canadian corporation for consideration that includes shares and that is the subject of a joint election. So number one, the property has to be eligible property. The definition of that term is in 85.1.1 of the Act, and what I will mention here is two types of property that are not eligible as opposed to the types of property that are eligible. Both types of ineligible property mainly have to do with real estate. First of all, real property owned by a non-resident typically does not qualify for a Section 85 transfer. The exception to that is where a non-resident is incorporating a Canadian branch operation. The second category of non-eligible property is real property held by any taxpayer, whether a Canadian resident or a non-resident, which is held as inventory as opposed to as capital property. I'm probably reviewing some basics here, but obviously what that tells you is that if you have a client who is wanting to transfer real estate to a corporation under Section 85, that you have to be certain that the property is not held as inventory and does in fact qualify as capital property, and there are certainly situations where it's a gray area. As I mentioned, the transferee has to be a taxable Canadian corporation. That's not usually a problem. Most Canadian corporations will qualify. In very odd situation, there'll be an issue as to that. The transferee corporation must issue shares as part of the consideration. As I said, the consideration isn't restricted to shares. It may include cash or a promissory note or the assumption of liabilities. All of that sort of non-share consideration is, for some reason, usually referred to as boot. The amount of the non-share consideration will affect the amount that can be elected on the transfer, and depending on whether it's higher than the tax cost, however, you may have a gain on the transfer. One of the questions that sometimes comes up is, when do the shares have to be issued? In some cases, there's an urgent need to do a Section 85 rollover, and you have a corporation that, for example, has only common shares, and you decide, for reasons which we'll get to later, that it's appropriate for the assets or the shares to be transferred in return for preferred shares. However, the preferred shares don't exist because it's necessary to file articles of amendment to create them. Can the transaction take place even though the shares that are to be issued don't exist? There was a case which is currently under appeal to the Federal Court of Appeal, a 1994 case called Dale and the Queen, in which the tax court took a very liberal view of the provisions of Section 85 and held that even in a situation where shares were not authorized at the time of the transfer, and in fact weren't authorized until I believe it was something like 3 years later, the transaction did qualify under Section 85. Now, I don't recommend following that practice. The case is, as I say, under appeal, but Revenue Canada's administrative position is in fact that the shares do not need to be issued or authorized for issuance at the time of the transfer, but you must take steps immediately to create the shares and to issue them. I've dealt with filing requirements. Again, I'm not going to go through the details of these. I think everyone knows that there's a joint election required. It's on a form called Form T2057. My recommendation, as I mentioned in the paper, is that you be very clear, both in the agreement itself and in any reporting letter to the client, as to who is going to have the responsibility to file the election. Normally, my recommendation would be that it be the responsibility of the client's accountants, at least in a situation where the lawyer is not a tax specialist. If the election is not filed on a timely basis, which is basically the earlier of the days on which the transferor and the transferee corporation have to file a tax return, there is provision in the Act to file a late election, and it does happen. And in fact, in some cases, elections are filed deliberately late because it's not entirely clear whether the client wants to trigger a gain on the transaction. There is the ability to file an election within 3 years of the initial due date as of right, and after 3 years, the minister has the discretion to allow a late election if it is just and equitable to do so. And there are some administrative practices as to the circumstances in which Revenue Canada will accept elections after the 3-year deadline, which I've set out in the paper. There's also an ability to amend an election which has been filed where it is found that there has been an error made, and again, the paper deals with the circumstances in which Revenue Canada will accept an amended election. In the case of any kind of late filed election, there is a penalty payable, but in most circumstances, it's well worth it to file the election late. The penalty can be waived under something that's usually referred to as the fairness package, which was introduced in 1991. But the situations in which penalties are waived under Section 85, I suspect, are not particularly broad. In my experience with obtaining waivers of penalty and interest under the fairness package is that in situations of financial difficulty, Revenue Canada is very often prepared to waive the penalties. In a situation where there's been illness and a clear inability to deal with matters such as this, again, that's probably a situation where penalties will be waived, but mere oversight is not likely to get their sympathy. I've mentioned in the paper the possibility that an election might need to be filed under provincial legislation. In most cases, it's not necessary because the Ontario, and I'm speaking only of Ontario here, but the Ontario Corporations Tax Act has a specific provision that says that an election that's filed for federal purposes will be treated as valid for provincial purposes as well. Couple of points. As I say, I'm not going to deal with the details of the rules that govern the elected amount, which will in turn then also result in the computation of the cost of the shares that are received on the transfer. Couple of troublesome points that, and I've had one question on this already. Under the Income Tax Act, there is an adjustment to the paid-up capital of any shares that are received on a Section 85 transfer and on most other rollover transactions. As you probably know, for corporate purposes, when assets are transferred to a corporation in return for property, the starting point would be that the corporation acquiring the property would add the value of the assets that are transferred to the stated capital of the shares that are issued. Stated capital generally will then be what we call paid-up capital for tax purposes. However, under Section 85, and as I mentioned, under most of the other rollover provisions, there is a reduction in the paid-up capital, which basically brings the paid-up capital of the shares back down to the amount that has been elected for tax purposes, less the amount of any cash or note or other boot that's received on the transfer. Now, there are two separate rules here, and again, you're probably familiar with with the provisions of Section 84.1, but I will mention this. On an asset transfer, the only assets rather than shares, generally the paid-up capital limitation is contained in Section 85 itself. It's 85.2.1, and as I mentioned, basically what it does is it limits the paid-up capital of the shares that are issued to the amounts that are elected for tax purposes. If the assets being transferred consist of shares of a corporation and several conditions are met, then the provisions of 84.1 will apply. And the usual situation is immediately recognizable. You have a shareholder who, for example, holds all of the shares of a company, which you might call OpCo. For whatever reason, it's desirable to transfer those shares to a holding company. After that transfer, the OpCo will clearly be what's called connected with the HoldCo, which is one of the conditions that results in the application of 84.1. The other condition is that the transferor is an individual who doesn't deal at arm's length with the transferee corporation. So again, in the situation I just mentioned, where you've got a sole shareholder transferring to a holding company of which he is the sole shareholder, or if there are other family members, he is clearly going to be non-arm's length with that company, and 84.1 will apply. But you should be aware that there are special tests that determine whether or not a transferor and a transferee deal at arm's length for the purposes of this particular section. Now, where 84.1 applies, the paid-up capital of the shares that are issued on the exchange may not be the elected amount. The rules in 84.1 will limit the paid-up capital to an amount which is the greater of the paid-up capital of the shares that are being transferred and the adjusted cost base of those shares. But the adjusted cost base is computed under some modified rules. And again, I've gone through that in the paper. And what I'll do is in a few moments, I'll come to the two forms of agreement which I've included in the material, one an asset transfer and one a share transfer, and you'll see the way in which the paid-up capital addition is dealt with. Normally, I would recommend that the stated capital for corporate purposes reflect the paid-up capital for tax purposes, even though it is possible for the stated capital to be determined under the normal corporate rules as being the fair market value. I think it's very helpful to be able to look at the balance sheet or the financial statements of the corporation and to know that what is on there as the stated capital will also be the paid-up capital for tax purposes, so that you don't have to keep going back to the minute book to determine what the paid-up capital is. And I think that's pretty much the standard practice. There are some other reasons for doing it. In some cases, it is better from the point of view of provincial capital tax or what's called large corporations tax. To limit the paid-up capital. Another point to be aware of on Section 85 transfers, and again something that I'm sure most of you have somewhere at least in your distant memory come up against, that is paragraph 85.1e.2, which deals with benefit conferrals. Again, if you're dealing with a situation where you have a transferor who is the sole shareholder or who is to be the sole shareholder of the transferee corporation, then 85.1e.2 probably is not a concern. This provision kicks in where the value of the property that's being transferred to the corporation is less than the value of what is received on the transfer, and it's reasonable to consider that there's an intention to confer benefit on a related party. So the simplest example is supposing you have two spouses who are shareholders of a corporation and one of the spouses wants to transfer additional property into the corporation. It's very important to ensure that the shares and the other consideration being taken back by the transferor will be at least equal to the value of what's being put into the corporation, because otherwise there would be generally a presumption that there was an intention to confer benefit on the other shareholder. The classic example of the application of 85(1)(e)(2) is in an estate freeze situation where you have a parent, for example, who wants to transfer property to a corporation and allow other family members to become common shareholders of the company for nominal consideration. 85(1)(e)(2) is the provision that results in the need for the shares that are received by the party transferring the property to have provisions that allow the redemption price to be adjusted if Revenue Canada disagrees with the value that's being assigned to the property at the time of the transfer. And as I mentioned, I've included in the material at the back of the paper some price adjustment provisions. That brings me to the question of valuations. One of the questions I often get in the context of a Section 85 transaction or other rollover situation is, how good does the valuation need to be? Obviously, valuations cost money, and there is reluctance in a lot of situations to go spend money on an independent valuation. The client often feels that he or she is in the best position to determine what the value of the transferred property is. In a situation where there are no other shareholders of the corporation, then I think from a practical perspective, valuation is not a very sensitive issue. You should be aware that on the Section 85 election form, you have to insert an amount for the fair market value of the property, and the reason for that is that it is one of the limiting factors on the amount that can be elected. But I think that probably the parties can sign an election form that certifies that the information is correct, so long as they have made a bona fide effort to come up with an estimate of fair market value. If, on the other hand, there are other shareholders in the transferee corporation, particularly if there are related shareholders, then I think that it is prudent to have some kind of independent confirmation of the value that's being arrived at by the transferor. Whether you need a full-scale formal valuation, I think is a question of how much exposure there is, probably a function of the value of the assets and the anticipated accrued gain. You might ask why you need a valuation if you have a price adjustment clause. The answer to that is the price adjustment clause is not a substitute for a valuation. Revenue Canada's position, and this is supported by the jurisprudence, is that it will honor a price adjustment clause if the parties have made a bona fide effort to determine the value of the property being transferred. Another point on price adjustment clauses is if you read Revenue Canada's interpretation bulletin, you'll see that there are a number of conditions set out in the bulletin which they say must be met in order for the price adjustment clause to be honored. One of those conditions is that the parties are supposed to notify Revenue Canada by a letter attached to their tax returns that there is a price adjustment clause in an agreement relating to a transfer of property in that year. In practice, Revenue Canada does not actually require this letter to be filed, and I think in part it's because the election form itself, T2057, which is filed on a Section 85 transfer, has a box that needs to be checked off to indicate that there is or is not a price adjustment provision in the agreement. Another point to mention, not strictly having to do with Section 85, but you have to be aware that in a transaction where property is transferred to a corporation and there are other family members, there may be attribution concerns. The attribution rules are generally rules that are anti-income splitting rules, and the particular rule that is of concern in the case of property transferred to a corporation that has other family members is 74.4 sub 2. What it does is impute interest to the transferor on the value of property that's transferred into a corporation in certain circumstances. So you need to be quite aware of that. Another provision, which I'll mention just very briefly, which is a bit of a sleeper, is the provision in subsection 6911. Again, technically doesn't have anything to do with section 85, and it's not limited, and I've dealt with this at page 17 of the paper. It's not limited to situations in which a Section 85 election is made, but basically what it is it's a provision that says that if property is transferred to a corporation or to any party who effectively is at arm's length with the transferor, and the purpose of the transfer is to utilize that arm's length party's tax losses or deductions, or to take advantage of that party's tax exempt status to shelter a gain or income arising on a subsequent disposition, then if the transaction took place in the first instance at less than fair market value, it will be deemed to take place at fair market value. So for example, and I should mention as well that it comes into play if there is a disposition of the property or an arrangement for the disposition of that property within 3 years of the date of the original transfer. So for example, a party may transfer property under Section 85 to a corporation that he deals with at arm's length because he's not the controlling shareholder. That corporation may have tax losses, and those losses might be used to shelter a gain on the property within a 3-year period. If that happens, the initial rollover may be denied. Again, in situations where you're dealing with a transfer to a related corporation, it's not an issue, but it is something to be aware of. I've also dealt in the paper with something called stop-loss rules, a very complicated area that is in the process of some substantial amendment, so I'm not going to go into any detail. General proposition is that on Section 85 transfers, the rules typically do not allow an elected amount that is higher than the value of the property. So if the property has actually gone down in value rather than appreciating, there would at least initially be a loss. In most situations, this loss, however, is going to be denied and it can't be currently claimed. In some cases, the loss will be added on to the cost of the property in the corporation to which it's transferred, and in some cases it's suspended and it can only be claimed when the corporation sells the property. But you should know that in general, Section 85 transfers that are done for the purpose of triggering a loss would not have the desired effect. Couple of points on taxes other than income taxes. Again, not an issue in the case of a share transfer, but if you're transferring assets, you're going to have to look at the potential application of other taxes. First issue is GST. Most asset transfers, at least if they involve the transfer of a business as a going concern, will be eligible for a Section 167 election, but you need to make sure that that's the case. There could be provincial sales tax. There are some exemptions available for related party transactions, but you should be aware that the main exemption, which I've referred to, is a one-time only exemption. So if property has been transferred on an exempt basis, it can't be transferred again. And final point on other taxes, land transfer tax. And again, there are some very limited exemptions or deferrals from land transfer tax. In some cases, it requires that the conveyance not be registered. So I've dealt with that in the paper. One other point, transferring assets. Very often, if a business is being transferred as a going concern, the assets will include accounts receivable. Typically, even though it's possible to make a Section 85 election on accounts receivable, you wouldn't want to. You'd want to make what's called a Section 22 election, which effectively allows the transferee corporation to step into the shoes of the transferor, so that if the accounts receivable go bad, an ordinary loss can be claimed. So in the agreement, you're going to want to carve out of the assets that are being transferred under Section 85 the accounts receivable and deal with them separately and make provision for a Section 22 election. So I guess I'm kind of running out of time, but I want to just make a couple of points about the agreements that I've included. The asset purchase agreement, you'll see that in this particular example, I assumed that the fair market value was not known at the date of the transfer, so it's the purchase price is simply defined to be the fair market value, although there's provision for estimating what the fair market value is. Part of the consideration in this agreement includes the assumption of liabilities, so that the agreement specifically deals with the need to allocate the liabilities, and in particular has a provision that says that the amount of liabilities that will be allocated to any particular asset won't exceed the elected amount, and that's necessary in order that that inadvertently the allocation of liabilities to a particular asset not trigger a gain. In section 4.1, which is the provision that deals with the elected amounts, I've tried to come up with a generic formula for the elected amount as opposed to scheduling a specific amount, but obviously whether you feel comfortable with that or is really a function of how many assets and whether it's possible to be certain about the tax cost. If you're transferring only a couple of assets and it's very clear what the tax cost is, you may simply want to schedule it. There is a clause in that section that provides for a minimum elected amount of $1 on any asset, and the purpose of that is to make sure that you don't leave out assets like goodwill or depreciable assets that have been depreciated down to a zero balance. It's basically a reminder that unless you put an elected amount on the asset, it's probably going to be deemed disposed of at fair market value, so you're going to end up with an unanticipated gain. 4.3 of the agreement is the provision that deals with the addition to the stated capital. And again, it's intended, I've done it generically so that it's basically the elected amount less the assumed liabilities as opposed to a fixed dollar amount. You'll see in 4.5 and 4.8 the references to the Section 167 election for goods and services tax and the Section 22 election. This particular precedent has a lot of reps and warranties, and whether they're necessary or not, I think is a debatable point, and it depends obviously on the circumstances and the relationship between the parties. Just to make the point again, made a suggestion that it be clear that the client's accountants have the principal responsibility for making sure that the elections are filed and for also ensuring that the transfer can take place without triggering any tax. That's a matter of reviewing the tax cost and looking at the liabilities that are to be assumed and making sure that there is not excess. There are not excess liabilities. Just a few comments on the share transfer agreement that I've included in the material. This agreement, unlike the asset transfer agreement, in this one I've assumed that there are other shareholders and that it's necessary to include price adjustment provisions in the share conditions, and the agreement itself makes reference to the requirement to comply with the price adjustment provisions. I've also assumed in this particular situation that Section 84.1 of the Act applies. So if you look at Section 3.2, the addition to the stated capital is limited to the greater of the paid-up capital of the transferred shares and the adjusted cost base of those shares determined for the purposes of Section 84.1. And there is a provision for a nunc-pro-tunc adjustment to the stated capital account if Revenue Canada were to disagree. I confess I think that this provision is untested, but from the point of view of needing to fix up something after the fact, I think it's helpful if you can show Revenue Canada that you specifically turned your mind to attempting to comply with the provisions of Section 84.1. So that's the reason for the inclusion. I can't guarantee that it's legally effective. On that point, just a couple of issues, because I very often get asked how to fix up a transaction in which 84.1 applied and the stated capital that was received was either greater than what it should have been under 84.1 or possibly even less. In other words, the parties didn't take full advantage of 84.1 and did not put enough paid-up capital on the shares. If the stated capital is too high, generally it's not a real problem, apart from the factor that I mentioned before, which is that it's an inconvenience to look at the balance sheet and know that it does not reflect the tax paid-up capital. It is possible to fix it. Normally, what I would recommend doing would be to take the shares and transfer them into another holding company and perhaps amalgamate the two companies in order to reduce the paid-up capital back down to what you want it to be for tax purposes. If the paid-up capital is too low, again, that would typically be the fix. That you can't really go increasing the paid-up capital of the shares because you'll have a deemed dividend. But normally, it would be possible to transfer them into another company and take back a higher amount of paid-up capital, relying on the fact that you can take the greater of the paid-up capital, the transferred shares, and the adjusted cost base. One other point, just before I finish, is if you're transferring shares under Section 85 and the purpose of the transfer is to trigger a capital gain in order to crystallize and use the capital gains exemption, again, very important to allocate responsibility for the planning and make sure that the client is properly advised on this. But there is an issue having to do with alternative minimum tax, which can be triggered on that type of transfer. And you have to be very clear that the client is aware of that and that the appropriate steps are taken to ensure that it's not going to be a problem. So I think I will finish with that. I don't know whether there are any questions. Sorry, I sort of went through that at breakneck speed. Yeah.
In the normal case, something like this is we have the accountant advising the client as to the tax consequences of these things. How is the responsibility being allocated to the accountant yourself in terms of this transaction?
Well, if you're asking how it's allocated between me and the accountant, or are you asking how it be allocated between
That's it between you and
someone who wasn't a tax specialist?
someone who's not a tax specialist.
Okay. I think my recommendation would be that if you're not a tax specialist, you get all of the advice from the accountant, or someone who is in fact giving tax advice to the client. I mean, basically, what you want to know is what type of shares should be received, which is a question, as I mentioned, of primarily, are there other shareholders in the company where you have to be concerned about benefit conferral? You want to be sure that if there is any assumption of liabilities or other non-share consideration, that it's not going to trigger a gain. And someone has to look at what the tax cost of the assets is and make sure that there won't be a gain. As I mentioned, there's potential for losses to arise on a transfer of assets, and the client may be thinking, well, I'll do this and I'll trigger a loss, and the loss might not be triggered. So, I mean, it's unfortunate, but the rules have become so technical and so complicated that truly, unless you're familiar with them, I wouldn't, I would make it very clear that the tax advice is coming from the accountants or whoever the tax advisors are, and what you're doing is implementing the transaction from a corporate point of view based on the instructions that you get, and I would get those instructions in writing from the accounting advisors.
Elizabeth, I actually had a couple questions, but one has already been asked, and that was the question of the allocation of responsibility. One question I have, though, is as I listen to you, you talk about the technical requirements, the how complicated it's become, the traps for the unwary, and so on. Do you feel that even a corporate lawyer can prepare these documents, or really would you prefer the tax lawyer, if you had the choice between the two, to even preparing the asset and the share transfer agreements?
Well, what I can tell you what we've tried to do in my office, which is we have a package of precedents, that you can basically access on your computer, and they come with a set of instructions that tell you, they give you some guidance as to how to use them, but with a big caveat that says this must be reviewed with, a lawyer in the tax department. The question that I got at the break, for example, was a very good one. I was asked about what gets added to the stated capital account in a situation where you don't know what the fair market value is, and how do you actually draft the resolution. We know that you can typically add a lesser amount to the stated capital account, but there is a requirement under the corporation's statutes for the directors to determine what the value of the property is that's transferred, and to determine that the value and to turn their minds to what the shares would have been issued for if they'd been issued for cash. And I find that most tax lawyers understand that provision better than a lot of corporate lawyers do. So I find very often that I'm sitting trying to draft the corporate resolution that that deals with it. So I think it's a matter of practice. I mean, some corporate lawyers are very comfortable and very familiar with the provisions, and they'll and all you've got to do is sort of look them over. And obviously, I would rather not be doing personally. I would rather not be doing the implementation myself.
Okay. Any other questions? Thank you. Our next speaker is Michael Disney. Up until now, we've been talking about how to prevent things from going wrong. Our next speaker, Michael Disney, is now going to talk about what to do when things do go wrong, and some suggestions how to resolve those problems.
After the complexities of the Income Tax Act, I'm going to try to keep this, as our American friends would say, real simple and real quick. I'm dealing really only with issues of corporate law, not the commercial law issues that this program has also ventured into. If you've glanced at my materials, you'll have seen that what I've done, given the somewhat open-ended nature of my subject, is to give a number of examples of where things have gotten thoroughly fouled up in the usually in the internal records and affairs of a corporation, and have suggested what a solution or the solution might be. In some cases, there clearly could be more than one possible solution. I'm not going to go through those materials with you now. I think you can read them at your leisure. What I want to do in the time I have available is to just talk about some of the underlying principles and themes of what I've said there, and to also address one very good question that was left with me at the break. It's fairly obvious, but I'll say it anyway, that in maintaining corporate records and keeping the affairs of a corporation in order generally, prevention is better than cure. And while it's very uninteresting and unrewarding to deal with things like keeping minute books and corporate records in order, there may be some ultimate benefit in doing so, because if you have a long-term client who ultimately comes to sell their company at some point down the road, you may find it a little embarrassing if the corporate records are in a state of total disarray because you haven't bothered much with them over the years. Obviously, that's the sort of advice that while everyone can agree with it, it often is going to be disregarded. And you often have no control over the matter because clients are understandably resistant to paying for lawyers to do apparently simple things that are primarily matters of record keeping. So they try to do them themselves or ask their accountants to do it, and it's often not done or not done properly. We had an instance in the past where a client graphically indicated their regard for their corporate records by keeping them in a horse trailer. And when we had to do a corporate review of the corporation, our law clerk thought that as a precaution she should put a plastic sheet over her desk and handle the minute book with rubber gloves. Fortunately, most clients don't go quite that far. The question that was raised with me at the break was a more common, although rather similar, instance of that kind of thing. The situation where you are given the minute book for a corporation by a client, and there is essentially nothing in it. It's clear that apart from incorporating the corporation at some point, there has been no attempt, either by them or by their former lawyer or anyone else, to maintain the records. And as far as one can tell, there are no issued shares. There are no directors, except presumably the ones named in the articles, and there are no officers. And the question really is, what, if anything, can you do about that? I think in many instances you can do something about it. The first step, obviously, is to question the client about it and find out if they at least have any thoughts in their mind whatsoever about what they thought the corporate organization was supposed to be. You know, if they think about it, presumably they will come up with some answer as to who the shareholders are supposed to be. And I think that it is not unreasonable, if you can ascertain what appears to have been the intention, to reconstruct the records on the premise that that intention should have been carried out. They just didn't actually prepare the resolutions and do the other things to actually put it down on paper. If there are financial statements, particularly if they're professionally prepared, again, that may give you some clue as to what the issued capital was supposed to be. Now, many people automatically assume that backdating is a bad thing. And I would say that it is in some circumstances, but in other circumstances it is not necessarily inappropriate at all. And clearly it's wrong to misrepresent the date upon which a document was actually executed. And similarly, it's also wrong to try to go back and pretend that something happened that really didn't happen, or that something that did happen didn't happen. You know, if a client tells you that he's decided that he should never have issued shares to his son, and wants you to tear up the resolution and put in a similar one with a similar date, issuing them to his daughter instead, clearly that's not a proper thing to do. However, in my view, there is nothing whatsoever improper about implementing later something that was clearly intended to be done at some prior time. One must remember that there is nothing wrong by contract in parties deciding that something is to have retroactive effect. There are, after all, no other interested parties involved in that situation. If all of the parties agree that that's what they intended and that's how their agreement should operate, there is nothing wrong with implementing that intention. Similarly, if all of the shareholders and other interested parties in connection with a corporation agree that they intended that a certain thing should have happened on a certain date and they just forgot to do a resolution, I don't think there is anything wrong in drawing up that resolution, dating it in such a way that it's clear that although it is signed currently, it is intended to have effect on the date when it was originally intended to have effect. So I think that you have to analyze with some care precisely what the nature of the problem is, and where it can be ascertained that the clients did form an intention as to what they were going to do and simply did not implement it properly. I think you can go back and reconstruct with some degree, at least, of retroactive effect what they should have done. In other instances, the problem may be more one that the records, although at least partially present, are not screwed up in some way. There, it can be probably more easily dealt with simply by passing current resolutions that confirm what should have happened and ratify it. It's not really a question of having retroactive effect as such. It is simply a matter of confirming the proper interpretation of what was done, and that is indeed what the present directors and shareholders view as having occurred, and what they intend should have occurred. There are, of course, situations where it really is not possible to completely solve this kind of conundrum. You may have a client who really just hasn't the faintest idea of what they intended to do. They never thought about it. And you really, in those situations, probably simply have to organize the corporation currently and proceed from there. And hope that, and of course explain to the client the implications of what you're doing, but hope that the blank period is not going to subsequently prove to be a problem. In organizing corporations generally, I have not attempted in my materials to get into the details of how to do that. There are numerous precedent sources that will do that for you. One or two suggestions on that is very common to use essentially an office incorporator, normally a lawyer, and to do the preliminary organization in-house before you turn it over to the client. I think that is, in general terms, a good practice to follow, because it means that at least the sort of first organization of the corporation is likely to be done properly. What happens then from then on, the client may mess it up, and probably will, but at least you don't have the situation where there's absolutely nothing there at the beginning. There are no shares, there are no permanent directors. Generally speaking, in using office incorporators, it's best to use lawyers, because lawyers are much easier to track down usually than other people if you subsequently need to confirm something or get something signed that was not done properly in the organization to begin with. I'd like to actually move to just some more general thoughts about this whole subject. As with any other legal issues, if you encounter a corporate problem of this kind, you have to analyze both the facts that are presented and the law that will apply to it. As I've already indicated, to an extent that is probably unusual in many other contexts, it may be possible for you to change the facts. Now, before you think, what is this crook saying? How do you change the facts? What I really mean is improving the facts, filling in gaps, making the corporate records reflect what was really intended. so that you have perhaps more opportunity than you may with many other legal issues to address them, not only from the standpoint of finding a legal solution, but also from the standpoint of simply, to some degree, making the problem go away if you can find support in the underlying circumstances for doing that. In the examples that I've given in my materials, there are some common themes, and I would just like to touch very briefly on what I see some of those themes as being. In a question of corporate law, you really have to begin with the statute. In present Canadian corporate law, about 98% of it, I would say, really is contained in the statute. And the present generation of statutes, although they're far from perfect, are at least intended to be, generally speaking, user-friendly and to get rid of many of the technical problems that bedeviled earlier corporate law. And it is always worthwhile, even if you think you know the statute fairly well, to take a look through it when you have a problem of this kind to see if there is something that may help you. Among the things that may help you are what I would call saving provisions or remedial provisions. For example, the provisions at the beginning of most of the business corporation statutes that attempt to get rid of the whole problem of ultra-virus and to validate transactions, notwithstanding that they may contravene even the statute itself. There are often specific saving provisions. There's one, for example, in the financial assistance provisions. There are saving provisions in the director's conflict of interest sections. In my material, I specifically point out one in the Ontario Act, which is quite useful and unfortunately has not been picked up in most of the other statutes. Sometimes the statute provides you with an answer where the documentation you're dealing with has not explicitly done something. There are many places in the statute where there are deeming rules or provisions that create a result essentially by operation of law that can make what may appear to be a problem go away. You know, I've again touched on a couple of those in my material, dealing, for example, with amalgamations. There are evidentiary provisions in the statute. Again, I've touched on those, ones that deem certificates, for example, to have conclusive effect, that can get you around some apparently very nasty problems where something has been on its face done in a way that does not comply at all with the statute. There are special remedies, and I've touched on some of those. I'm sure Rita would not want me to suggest that you should always go running to the company's branch to try to get articles corrected or certificates canceled, and I think those remedies clearly are not going to be provided every time you make a mistake, but they are there, and in some circumstances they are worth considering as being a solution to something that otherwise is quite intractable. As I mentioned before, it's not necessarily difficult to implement something retroactively where it's simply between private parties. If, however, you have a public document out there like articles, it may well be that no one has relied on them in respect of some error that they contain. So the problem may be more a technical than a substantive one, but you still have the problem that they're there. You can't pretend they're not there. And the options you have to make them go away where they are in error are quite limited. But I have dealt with some of those and made some suggestions about how you may be able to at least alleviate those kinds of problems. As I indicated, although the statute may be, I said 98% of corporate law, there are still some situations where the answer is to be found somewhere else, and I've thrown in at least one example of that, where you may have to go and look at some other corporate law to find out a way that has already been found to solve a particular problem. The example I use in my paper is where assets have not been fully disposed of on the dissolution of a corporation, and you have a problem with an apparent escheat to the Crown. Now, there is an answer to that, but it's not in the statute. Finally, all of this kind of analysis of corporate problems that occur ultimately has to be looked at in a practical light. In other words, given that something has gone wrong, does it really matter? Who's going to care, and how much are they going to care? I'm not dealing here with the kinds of real disagreements that are going to send your clients to court under the oppression remedy or other similar remedies. Many of these technical issues are simply a matter really of risk assessment, and it's ultimately a matter for you to explain to your client just how much risk there may be from the fact that they don't seem to know precisely how many shares they have outstanding or who owns them and that kind of thing, and what degree of protection do they really need. For example, if your client is purchasing a corporation which that has these kinds of defects in its records, which is very common, they may well decide after you've explained to them what the situation is that they will live with just an indemnity from the vendors to cover any potential claims that might arise. If you believe, having reviewed the records, that the problem is likely more apparent than real. Obviously, I can't emphasize too much that the client has to fully understand the risks before they decide to at least partially accept them. I think that really covers the sort of outline that I want to give. As I said, I recommend that you read the material I've prepared at your leisure. It does come with some precedents, which may be of some interest. And I hope that some of the situations I discuss will at least give you some ideas for how you would go about solving these kinds of problems.
Thank you, Michael. We're running a little bit behind schedule, so we'll turn to our last speaker. I guess last but not least, we've invited a litigator into the den of the commercial lawyers. And Robert's talk today, Robert Staley, is going to discuss what steps we can take as corporate and commercial lawyers so that we don't need his services. So without any further ado.
Okay, thank you. I think that we may actually have a paper here for you. If we just take a second, you just check.
Litigators always like a bit of drama.
Paper, I wondered if we could, I don't know if you could address the paper, like the issue of resident Canadian records. Periodically, I find that foreign subsidiaries and corporations are offside of the department, not about the information.
Yes, I actually do touch on that in my material. The short answer is that usually the way of at least alleviating the fact that the corporation is sort of hamstrung by not having a proper board is to put in place a unanimous shareholder agreement, at least in the short term until they resolve the problem. That, of course, does not get them out of hot water with the ministry because, of course, if they have to file form at some point and it indicates that there is non-compliance with the requirement, they're going to have to do something about it at that point. And unfortunately, the unanimous shareholder agreement does not absolve you from having a proper board, even if it doesn't do anything.
For Robert's presentation, we're going to take somewhat of a little bit of an unorthodox procedure. Robert has written his paper and has in there a number of points, I think about 10 points at least, on things that commercial lawyers can do, corporate lawyers can do to avoid problems. I thought what Robert would do was introduce the point and then open it up to some discussion within the group.
Thank you. First, I want to just apologize for the delay in getting you the paper. I'm basically suffering from substantial sleep deprivation in the middle of a statutory plan of arrangement right now, and spend most of the morning negotiating with the CBCA director in Ottawa about whether she's going to show up and object tomorrow at my first return date. So it also means that I wasn't able to get you the paper as soon as I would have liked to have done that. I want to begin by thanking you for the invitation, Mr. Chair, to speak today. I am pleased that somebody has acknowledged that litigation lawyers have something valuable to teach to corporate lawyers. I know there are most of my partners who would disagree strongly with that proposition. Since you have extended this invitation to me, what I want to do today is share with you a few insights that I've gained from almost 10 years of practice. In the 10 years, I've had a very practice that includes at its basis commercial litigation, done a lot of oppression-related litigation, shareholder litigation. I've also done and still do some defense work in law society, professional discipline matters, which gives me a different perspective on some of the issues that can give rise to trouble in the legal profession. And as well, as part of that, I did at one point act as junior counsel in what was known as the Lang-Mitchner prosecution. So I got some senses of how some things there for a very large and respected firm can go seriously wrong. In addition, I still do some work of accountant's defense work for the CICA, so I see how some of the problems that can affect you do affect your brothers in the accounting profession. So what I'll do today is give you my 10 lessons. The first lesson is don't ignore conflicts of interest. And I want to begin by getting to the very heart of an issue that's causing a lot of angst in the legal profession these days, including a lot of angst for my firm in particular. I don't know how many of you here subscribe to Canadian Lawyer magazine. Probably a lot of you do. You may have seen the article in the most recent edition titled "The Gray Zone: Conflicts of Interest." And we have the privilege or notoriety of being dealt with in a story here that's a sub-story within the story that says one firm's troubles with conflicts, and the firm in question is my firm, Bennett Jones Verschere. Now, what I want to is just to quote from some aspects of the story to give you some idea of the types of problems that firms are facing. Begins by saying, trying to slide through the practice rules maze without triggering an alarm is more difficult these days. Just asked Cliff O'Brien of Calgary's Bennett Jones Verschere. And Cliff is the head of our litigation department in Calgary. And it goes on to talk about how we were scolded recently in 2 cases where the court concluded that the firm was involved in conflicts. And then quoting Cliff, it says, "We felt we were sensitive to conflicts, but certainly this judgment has sensitized us further," says O'Brien. Clearly, the way the trend is going, we have to be very, very sensitive to the fact that increasingly you're not going to be permitted to act where there may have been some representation in the past. Now, one of the issues that was dealt with in this story and in the case that gave rise to it was a situation where our Calgary office acted for 2 applicants in a joint application to the National Energy Board for various licenses. Now, you would normally think, and I think it was the firm's thought, that in that context, because there was a joint retainer, by definition, there could not be any conflicts as between one client and the other, because there would be an obligation to make full disclosure of confidences. What happened subsequently was that the 2 clients got into a dispute, and the firm decided that it would act for the one client of the firm who had been its long-standing, long-term client, and did so in connection with a piece of litigation. The other client that had come to the firm only for the purpose of that application said, no, you've got a conflict, and then the firm said, no, we don't think we do, because after all, it's a joint retainer. There can't be any confidences in this context. Unfortunately for us, the court disagreed and concluded that we should be removed as the solicitors of record in that case. And just to finish a quote from the story, it says this: if the rules are narrowing, they're not becoming any clearer. O'Brien says Bennett Jones Verschere's lawyers in the Bow Valley, San Diego matter saw no blatant conflict. You must recognize that a large law firm and one that has as many clients in a smaller community as such as Calgary were bound to run into a lot of conflicts. He says, I understand that, quoting the Judge, Clark thought it should be obvious, but with all due respect, it wasn't to the lawyers involved. Now, the fact that we face conflicts like that may be a reflection of the position the firm holds in Calgary, which is relatively speaking a small market, but they serve, I think, as lessons for all of us. I think one of the things we should be thinking about as lawyers, and you should be thinking about as corporate lawyers, is to be very careful in situations where there's a joint retainer. You should understand who you're acting for. If you're acting, as you often will do in a connection with, for example, a shareholders agreement, who's your client in a shareholders agreement? Are you acting for all of the shareholders? Are you acting for the company or some of the shareholders? You need to think about these issues, and you need to understand them and document them at an early stage in the transaction. You need to understand as well what's going to happen if there's a conflict. Is somebody going to go get ILA, or is that not going to happen? There is always a concern and a tendency when you have got people who want you to do legal work for them not to send them to somebody else. There's always a natural tendency to say, no, please come to me, I'd be glad to do the legal work for you. But unfortunately what you'll find happening is that when that happens and something goes wrong, the first person somebody turns to is the lawyer and says, no, the problem I had is because you were acting for everybody and you didn't give to me the duty of loyalty and the care that you owed me. So that's one of the first things I think you need to be sensitized to. Yes, conflicts have become a tactic that's used now in litigation arising out of the Martin and Gray case. It's used as a tactic in litigation now all the time to get lawyers disqualified. It's like the first standard motion you think about after you decide whether to attack someone's pleadings is whether you're going to try to remove a lawyer or solicitor of record. It happens a lot, but you need to understand how it does apply and frequently occurs in a corporate context and how it can affect your practice. Are there any questions at all on this point? Yes?
So when we're doing a shareholders agreement, I often find myself in a case where I need a lead lawyer there, so I'm taking the position that I'm acting for one party.
Yes.
In a family matter or a family matter. And you cover yourself by sending out a letter saying, I'm only acting for you, and you should all get independent representation, but you know that they're not, and you know that they're going to take the agreement that you drafted and sign it.
Yes. You always know that there'll be people who don't take the advice that you give them, and clients by nature often do things that are stupid that they shouldn't do. And we're going to come a little bit later. We could look down at some of the other points about the importance of papering and keeping adequate records. But it's an issue that you have to address. You need to make sure that as far as the written file is concerned, in terms of how you are conducting yourself, that you are not appearing to be giving them legal advice that they're relying upon, and that you've got an adequate record that they're not looking to you for advice, and that you're acting for somebody else. I've got a case right now where someone made a very substantial purchase of assets, and they were given advice by everybody and their uncle that they should go get lawyers, decided not to do it, and of course the predictable thing happens, there's a big mistake, and suddenly they start blaming the lawyers involved. But I think in that case the paper record is sufficiently clear that the lawyer has no difficulties, but that's not to say somebody won't come at you at some point and say, yeah, you got a problem. Anyone else on conflicts? Okay, let's go to the next point that's raised in the paper. And that's just has to do with keeping client confidential. And it's really a very basic lesson, but it's one that's often overlooked. It is very, very easy for somebody to talk out of turn and to get into a lot of trouble in the process. The obvious example of where that can cause a problem is where you've got someone involved in a corporate securities transaction, lets slip that something is going on, and then suddenly somebody goes out and buys or sells some securities when you see some unusual activity. But it can happen in a much more innocent way. Like a good number of you, I'm sure, I'm married. I often say things to my wife about what I'm doing at work, and occasionally I'm just having to tell her just to make sure that what I'm telling her in any particular case is something that she shouldn't be talking to her friend Marilyn and Marilyn's best friend. And so it can happen in a lot of different ways. We are in an elevator bank in the First Canadian Place where there's other law firms. And I'm surprised by how often you're in the elevator and you're hearing people talk about cases. And it's happened on occasions that they're talking about a case that you have some other familiarity with because you're involved in it and no one knows. So it's just a really important point to bear in mind that, quite apart from the very obvious examples of not tipping brokers, which are obvious, there's a lot of other more innocuous ways where things can get out. And when they get out and if they cause harm, then you're looking as a lawyer possibly at an action for breach of fiduciary duty, one for breach of confidence, but you're getting yourself into a lot of trouble in the process that you really would prefer to avoid. It's said that loose lips sink ships, but loose lips will get you sued. So that as my second basic lesson from a litigator is watch what you say, watch what your employees say, watch what your staff says to other people, and do your best to maintain the confidences that are entrusted to you as a lawyer. Any thoughts or questions on that? Okay. The third point is don't do business with a client, and that may be overstating it slightly because perhaps what you should be saying is that to exercise extreme care before you do business with a client. But I have seen this a lot in the context of acting for accountants who get sued, that there is a real problem that arises where the accountant and the client do business, although I've had the same issues arise when I've done some discipline work for lawyers, including a lawyer who got disbarred on one occasion for entering into real estate transactions with a client. And the basic lesson here is that it would be best if you could arrange your practice so you're not in a position where you need to do business with a client, because whenever you do that, you've got 2 or 3 strikes against you from the outset. You certainly would want to make sure the client has independent legal advice. But what we've seen happen, and particularly with the more recent decision of the Supreme Court of Canada and Hodgkinson and Sims, which I think is a '94 decision, the court has imposed fiduciary duties upon people like lawyers and accountants who are involved in giving investment advice, who are involved in transactions with clients. And this is often imposed in situations where at the beginning of the relationship, as it's so often the case, everything is just fine, and then something goes seriously bad. And what often goes seriously bad is real estate goes south, and then you get into problems. And what often happens in these situations for lawyers and accountants, from my observation, is that the initial reaction on the part of the lawyer or the accountant is not to come and make a clean breast of things and say we have a serious problem, but then to go and try to do things to fix the problem so the client is happy. And so this misguided sense of wanting to serve the client well, or at least not let the client know there's a problem, is the initial instinct. And that's a bad instinct, because what happens in that case is that when the lawyer becomes involved in a way without telling the client and doing things, the lawyer becomes effectively a guarantor of the transaction. So quite apart from the issues that are raised at the outset of the relationship as to whether it's advisable for the client and the lawyer to get into the transaction, when things go wrong, the best instinct is not to conceal, is not to do things that keep the client in the dark or try to somehow generate funds so that everyone thinks everything is fine. The best instinct is to make a clean breast of things. And if you don't do that, you're going to get yourself into a lot of trouble. There's another aspect of this topic that I also think merits some discussion, and that has to do with serving as a director. There's a great many corporate lawyers who want to serve as directors of client companies, and I think that's something that law firms generally promote as a matter of practice. I mean, you will often judge the value of a senior partner in a law firm by the number of serious directorships the person holds, and those are all good things. What's important to bear in mind in the process is that in serving as a director, the director has imposed upon him substantial duties and obligations, and you've got to be particularly careful in meeting those obligations. Some of those are set out in the paper at page 14, but you want to take care to exercise reasonable steps to guard against unlawful acts, to avoid liability. You want to make sure that the director is exercising due diligence. And certainly as a law firm, if you've got directors or lawyers serving as directors, you'd want to make sure that you're adequately protected by way of your insurance in case, or the company's insurance in case something goes wrong. So in a great many ways, you should take exceptional efforts to be careful when you're doing business with a client, either engaging directly in transactions with a client or alternatively in serving as a director of a client company. The next lesson is to communicate effectively. And one of the things that I've learned now in almost 10 years of practice is that clients want to know that you love them, and they want to be kept informed. And oftentimes clients are not particularly good purchasers of legal services. They don't have the ability to tell whether or not you've done a job for them well or poorly. Now, it's different in litigation sometimes, because they will judge you by whether you've won or lost, which itself is not necessarily an indication of the job you've done. But clients often have no idea as to whether they're being well served. What they do know is whether or not you are returning telephone calls in a timely fashion. They know whether you're returning their letters or responding to their messages in a timely fashion. They know whether or not you are getting the work done as quickly as you said you would, or as quickly as they would like. And so these are all little things to keep in mind, because what happens, unfortunately, in many instances is that when the client feels as though they're not being well served, when the little things are not being done well, you will find that the relationship suffers, and then they begin to look more critically at the substantive work that you are doing. And they'll often interpret the lack of a return phone call as an expression of disinterest, or as a manifestation of some other problem that's affecting the work you're doing for them. So I'm sure it's also a good aspect of time management, but as much as you can do so, making an effort to return telephone calls from clients that day. If you can't do it, have your secretary phone and say, Mr. Staley or Mr. So-and-so will phone you tomorrow. He's tied up in court today, or he's in a closing. But do all those little things right that let the client know that you love them. The other thing you've got to do is you've got to make sure, as part of effective communication, that you confirm important instructions from the client. You don't want to find yourself in a situation where there is an issue come between you and the client as to who said what about a particular matter, particularly if the matter is of some importance. And I can recall an incident that occurred when I was a relatively junior lawyer, where there was an issue between myself and a junior in-house counsel and a client as to whether I had received certain instructions. And I was fortunate at the time that I had a contemporaneous record of that conversation, which corroborated my evidence that I had been given instructions to do what I had done. But it was a matter of some embarrassment at the time that we had to go through the process of dealing with all of that. But it's a basic aspect of good client relations, is to keep appropriate records and make sure that you either have, for some transactions in some instances, a memo to file. In others, you want to simply confirm the instructions in writing by sending a letter or fax confirming those instructions, oftentimes before you'll act upon the instructions that you've received. Any questions all about that? Point 5 is really carries through the last one, which is that when you have a significant matter, you should make sure that you get clear instructions on that matter. And that means that particularly in issues related to significant aspects of a transaction, or where you're dealing with a settlement of a dispute, it's always wise to make sure that before you take the seminal step, which will commit a client to a position, that you get some sort of confirmation. Clients often don't like to send letters of instruction, but they don't mind you sending them confirming letters. And that's something that you want to think about doing in appropriate cases. You've got to use some good judgment as to when you need to do that. But my advice to you would be, from given the lawsuits I've seen over the years, that when in doubt, do it rather than not do it. And you'll save yourself a lot of headaches in the process of all of that. Lesson 6 deals with giving business advice. And while it's important to be careful in giving advice on non-legal matters, I think we would all agree that the people who are often recognized as being the best corporate lawyers are the people who are best at giving practical business advice to their clients. Someone once said of one of my partners that he was the best businessman's lawyer in Canada. And in saying that, I think what he was acknowledging was that the advice that he was giving to his clients on business transactions had a sound business basis, which reflected my partner's experience for having spent some years as a CEO of a company. And so what you get, I think, is on the one hand a tendency to want to be able to give your clients business advice, because they will like you if you can give them sound practical advice that's not legal. On the other hand, a concern about straying outside of your areas of expertise. And I guess the only advice I would give to you here is it's important, if you can do so, and if you have this type of relation with your client, to make sure that the client knows what advice it is that they're getting. I will often, with a client, when I'm giving advice on litigation, say, this is my advice to you as your litigation counsel. Now I'm going to give you some practical advice, which reflects my experiences, which I'm not giving to you because I pretend to have any particular expertise in the area. And you don't necessarily say all those words, but that's the concept you want to get across. And it's important to you, I think, that in terms of not getting sued, that their clients understand the limits of your expertise. If you really have been a CEO of a company, if you really have got that practical experience, then you may feel you don't have to do all of that, and that may be true. But in terms of the advice you're giving, the client, when he finds 2 or 3 days left or the transaction is closed, that this market has gone south, or he finds that his investment has gone bad, may not have a memory for knowing what exactly it is that you told him wasn't legal advice, but business advice. And maybe coming to you and saying, well, you told me to buy that. Why did you tell me to do that? And if you're going to get into giving advice like that, again, you should think about maintaining appropriate records where you're straying beyond areas of your expertise so that there's some acknowledgement in somewhere other than your brain as to what you were doing at the time you told the client about that particular transaction. Lesson 7 is know your partner. And this is an issue that is raised both for large and small firms. We have heard of, in the last number of years, of a large number of instances where partners have left large firms under a cloud because of allegations of impropriety, and that has not only affected lawyers but also accountants. There was a story in the paper recently about some people who left Doane Raymond under circumstances where there was some allegations that things had happened that shouldn't have happened. So what we're seeing here is a manifestation of a lot of trends in society where at one point in time you had small partnerships and people trust each other. Now we're seeing in some instances large partnerships where you get the occasional bad apple. And it's important for you, whether you're in a large firm or a small firm, to know your partners know what they're up to and to have in place internal systems and controls to allow you in some fashion to monitor what's going on, because as a partner with someone else, you'll be liable with them jointly and severally if something goes awry and the partnership gets sued. I have seen instances of this acting in defense of accounting firms where you get a small practice where you've got two people who basically are in association. They have independent practices entirely, where one is a completely bad apple and is doing all sorts of terrible things, investing with clients, hiding from clients problems. The other one is, the guy who goes to church twice on Sunday. But they both get sued when things go awry. And so you have to exercise extreme care and think about how it is in a practical basis you can know what your partner is up to. What systems do you have to watch what your partner is up to? And be careful to watch for warning signs that arise. And those warning signs will often arise where somebody who is the client of the partner who you're concerned about starts calling somebody else for help because they have a problem. And you should think carefully before you simply refer them back to the partner in question. You might want to think about, why am I getting this call? Why is the managing partner getting this call? What's going on here? But to think very carefully in a preventive sense to try to watch for problems that can arise and to deal with them proactively rather than reactively, which is often what happens. Lesson 8 just deals with giving undertakings, and the point is nothing more than don't give undertakings that are impossible to keep. And if you're giving an undertaking, make it clear whether you're giving the undertaking personally or on behalf of the client, so the client is bound by it but not you. I was on the phone this morning with the director's office, and I had to undertake to utter certain words in court tomorrow on the plan of arrangement. Otherwise, they were going to show up and say nasty things about us. So those are things that are easily done. And before I left here at about 11:30, I sent out a confirming letter confirming my undertaking to the director under the CPCA so they would know what I was going to say tomorrow. But you need to be careful about that, and when there's any issue as to an undertaking you should make a point of confirming the undertaking in writing so the scope of the undertaking and who the undertaking rests upon is clear. The other point I want to make, which is in Lesson 9, is to recognize the limits of professional competence. I once was with a firm where a lawyer who was with the firm during bar ads, wrote a book. The book is a well-known book and has lots and lots of good understanding of the cases in a particular area of law. The person came back from bar ads and began to practice in the area, and began to practice as though the person had practiced for 10 or 15 years. And as a corporate lawyer, found himself embroiled in certain litigious disputes where he didn't realize that he was being set up by the other side, because while he had a lot of book knowledge, had very little practical experience. And so if I could give you any advice, as much as it's easy to read a lot of cases and have some understanding, you have to be very careful to know the scope of what you're capable of doing, and to realize that there is times when you got to go talk to somebody else, even if it's only just to confirm what you're doing is right, before you take the next step. Having said that, it can happen to senior lawyers. I recall a case once where there was a significant corporate matter that was going seriously awry, and what was happening, unknown to the corporate partner at my firm at the time, was that there was pre-litigation jockeying going on, and people were writing what in effect were letters to build a record. And when I saw what was being written, my first instinct was, these letters have been written over at Tories in the litigation department. And I reacted in absolute horror, because I had seen letters in response to those letters which weren't informed of the fact that somebody else seemed to be writing a record for litigation. And sure enough, when it got into litigation, who got on the record but Tories? So these are the types of things you got to be careful about. Be careful about understanding when a corporate matter or a corporate dispute has become a litigious dispute. Know when you have to bite the bullet and go talk to a litigator, and understand the limits of what you can do as a corporate lawyer. The last point is really just a general one, and that's not to neglect the details. And it is so easy to make very careless mistakes that can cost the client a lot of time and money. And it's often the little errors that don't get caught because somebody isn't paying attention that can cause the real problems later. I know it's my practice when I'm preparing court documents to spend a lot of time at the last minute poring over them to make sure that they're, as far as I'm concerned, they're absolutely right. I don't leave the final proofreading or the final review to a junior lawyer. It's just not how I do things. And I think it's important for you when you've got significant transactions, when you're involved in something where what you're doing makes a difference, to make sure that what goes out of your office has been reviewed by you and you're satisfied that what has been done is proper, because it's the little things that can go wrong that can cause problems. It's the wrong description in a real estate document, the wrong name of a company in a guarantee, that can cause all sorts of problems. And I've seen that in my years of practice, that it's the little things where somebody doesn't intend to do something one way, which at the time could be easily fixed because there's goodwill between the parties and the parties are cooperating. But when things go seriously awry later, suddenly people are taking different positions, saying, no, that wasn't what we intended. No, I wouldn't have agreed to that at the time. And so you've got to be very careful as you walk through your practice to understand that you have to get it right the first time, because it can be very expensive to you and to everybody if you have to go back and try to make it right later. So what I've done today is try to give you what, in my experience, are 10 lessons that you should seek to apply and at least try to think about as you practice corporate and commercial law. Most of what I've told you today wouldn't be considered in any sense rocket science. It's good common sense. And in the spirit of the commercial list, which has a series of canons, let me end by giving you 3 canons, which are the 3 B's, which if you think about them and practice in accord with them, you'll do well. Be aware, be wise, and finally, be careful. I'd be glad to answer any question anyone has about any of the rest of this. Yes?
Actually, I don't have a question, a comment. I was really very glad to read through lesson 3 here. I'm not a lawyer, obviously. I can't give anyone legal advice, but I can give you practical advice with regard to becoming directors and officers of corporations.
Yes.
Particularly with regard to being the first director of a corporation.
Yep.
I have seen hundreds and hundreds and hundreds of documents where lawyers and or secretaries and or law clerks are the first directors of a corporation. Your principals are out of the country, or they can't come into your office to sign. You need their signature, so you get somebody to put their name down. I know of one senior law clerk at a very large Toronto law firm who was on the board of directors of 86 corporations. Now, he knows he incorporated these things, figuring that then the senior partner or whomever was responsible for these corporations or the company themselves would file the initial notice to take him off and put themselves on. Well, hello there, he's still on 86 of them, and unfortunately, in 91, 93, I can never remember the date, when we had the big flip-flops of the apartment deals where the organized crime was sort of being investigated by the Ontario government, he was found to be on the board of directors of a lot of the companies that Mr. X and his partner were involved in. I cannot stress to you how important that is, so I'm really, really glad that Robert included that here. I would never have thought to do that, but
Yeah, but if I
very
could,
serious.
at the risk of telling war stories, another example that follows from that is that if you cease to be a director, you want to make sure that the appropriate notices have been filed. One of my partners came to me last year and had received a letter from I think that's the corporation's tax branch, I forget who it was, but they were asking him to remit a check for $600,000 in respect of a company that owed money to the provincial government. And he said, well, I ceased to be a director of the company sometime in the 1970s. And we had to go back and find some corporate records to establish that, in fact, he had ceased to be a director, and in fact, that there had at the time been documents filed with the company's branch to show that. But if we couldn't have shown that, we would have had some serious problems. So it's not just don't make a mistake when you get on as a director to get off if you're initial director, but also make sure that if you leave a board, that the appropriate paperwork has been done. Any other questions?
If I might just comment on that last point, I think Cote's advice in the materials, don't act as an incorporator, unfortunately really will not work in the real world. There are lots of situations where, for timing reasons, you just cannot get the client to sign the articles. And as I mentioned earlier, there are also practical reasons why you may want to keep the organization of the corporation under your own control, namely that you will do it properly, whereas the client will probably bungle it. However, it is, as has been said, extremely important to make sure that you have very clearly in mind how you are going to get off as a first director. And you need to do that before the corporation starts to do anything serious. And not only do you not want to be there 20 years later, but inadvertently, but you also don't really want to be the first directors in place when the corporation enters into its first significant transaction.
Yeah.
You can now resign if you're the original incorporator without another director.
There is a problem with that, unfortunately, under at least some of the statutes, which is why I think you really need to pre-plan how you're going to get the thing turned over to the client, and you've got to make sure it happens, because if there is no replacement director, you can find out that you're stuck. You can't get out of that role.
Thank you, Robert.
Thank you.
That concludes our program. I want to thank all of you. If you could please fill out the evaluation forms. I hope you've had some food for thought, and speaking for myself, I'm going to go back to the office and check on a couple files.